Hello, and welcome to Boni's Life, the channel where we navigate the beautiful, chaotic, and often downright confusing world of cryptocurrency. I'm your host, Boni, and today we're diving deep into the digital trenches to make sense of the current crypto climate. Whether you're a seasoned trader with a multi-screen setup that looks like something out of a sci-fi movie, or you're just starting to dip your toes into the crypto waters, this episode is for you. We're in a fascinating period, a time of what I like to call extreme fear. And no, that's not just my emotional state after checking my portfolio this morning. The fear and greed index is currently flashing a big red 11, which in the crypto world is the equivalent of a horror movie jump scare. But is it a sign to run for the hills, or is it a golden opportunity to buy the dip? That's the million-dollar question, isn't it? And today, we're going to answer it. We'll be dissecting the market from every angle, looking at the short-term, mid-term, and long-term perspectives. We'll be your crypto optometrist, fitting you with the right lenses to see the market clearly. We'll cover everything from the nitty-gritty of technical analysis to the grand-scale drama of global economic events. And of course, we'll be talking numbers, real up-to-the-minute numbers pulled directly from CoinGecko and CoinGlass. Because in the world of trading, data is king. So grab your coffee, settle in, and let's get ready to decode the crypto market together. By the end of this episode, you'll have a clearer picture of where we are, where we might be going, and most importantly, how you can navigate these turbulent waters without getting completely soaked. Let's get started. All right, let's start with a snapshot of the market as it stands today, December 16th, 2025. The total cryptocurrency market capitalization is hovering around a cool $3.05 trillion. Now, that might sound like a lot of money, and it is, but it's actually down about 3% in the last 24 hours. It's like the market had a bit too much fun over the weekend and is now nursing a slight hangover. Year over year, we're looking at a decline of 22.1%, which tells us that the market has been through quite a correction from its previous highs. Bitcoin, the king of crypto, is currently trading at around $87,500. It's seen a modest gain of about 1.3% in the last 24 hours, but it's been a bumpy ride. Over the past 7 days, Bitcoin is up approximately 3.1%, showing some resilience despite the broader market weakness. The market cap for Bitcoin stands at an impressive $1.75 trillion, and its dominance in the crypto space is a commanding 57.1%. This dominance is crucial because when Bitcoin's dominance rises, it often signals a flight to safety within the crypto market, with investors moving away from riskier altcoins. Ethereum, the queen of smart contracts, is at approximately $2,930, also up slightly by 1.9% in the last 24 hours. Over the past week, Ethereum has shown stronger performance with a 9.9% gain, outpacing Bitcoin. Ethereum's market cap sits at around $353.6 billion, representing 11.6% of the total crypto market. The 24-hour trading volume for Bitcoin is a staggering $98.44 billion, while Ethereum is seeing $28.29 billion in volume. These volume figures are critical because they indicate the level of market activity and liquidity. But the real story is in the sentiment. That fear and greed index I mentioned, it's at 11. To put that in perspective, a value of 0 is extreme fear, and 100 is extreme greed. So we're definitely in the everyone is panicking zone. Yesterday, the index was at 16, last week it was 22, and last month it hit 10. This persistent extreme fear suggests that market participants are deeply concerned about the current price action and future direction. But as the legendary investor Warren Buffett once said, be fearful when others are greedy, and greedy when others are fearful. Is it time to be greedy? We'll see. Now, let's talk about the big scary word, liquidations. In the last 24 hours, we've seen a staggering $697 million in liquidations. That's a 170% increase from the previous day. For those of you who are new to this, liquidations are when a trader's position is automatically closed by the exchange because they can no longer meet the margin requirements. It's a forced sale, and it can have a cascading effect on the market. It's like a margin call on a massive decentralized scale, and right now the short positions are slightly outweighing the long positions, with a 51.45% to 48.55% split. This suggests that more traders are betting on the price going down than up. It's a tug of war, and the bears seem to have a slight edge at the moment. The total open interest across all cryptocurrencies stands at $127.5 billion, with Bitcoin alone accounting for $59.25 billion of that figure. Open interest represents the total number of outstanding derivative contracts that have not been settled. A rising open interest typically indicates new money flowing into the market, while declining open interest can signal that positions are being closed. The current levels suggest there's still significant leveraged exposure in the market, which can amplify both upward and downward price movements. Now, let's zoom out from the charts and look at the bigger picture. The crypto market doesn't exist in a vacuum. It's influenced by a whole host of global economic events, and right now, all eyes are on the Federal Reserve. On December 10th, the Fed announced a 25 basis point rate cut, bringing the federal funds rate to a range of 3.5% to 3.75%. This was the third rate cut this year, but it was a hawkish cut, meaning it came with a side of caution. The Fed's own projections suggest a slower pace of rate cuts ahead, with only one more expected in 2026 and another in 2027. This signals that the Fed is in a wait-and-see mode, carefully observing how the economy evolves. The vote was 9-3, which is notable because we haven't seen 3 dissenting votes since September 2019. Governor Stephen Miran favored a steeper 50 basis point cut, while regional presidents Jeffrey Schmid and Austin Goolsbee wanted to hold rates steady. This division creates uncertainty, and the market hates uncertainty more than a cat hates a bath. So, what does this mean for crypto? A rate cut is generally seen as a positive for risk assets like cryptocurrencies. Lower interest rates can make traditional investments like bonds less attractive, pushing investors to seek higher returns elsewhere. However, the hawkish tone of the announcement has tempered some of that optimism. The market is like a student who got a good grade on a test, but was also told they need to study harder for the final exam. The initial reaction was a bounce in Bitcoin's price from around $80,000 lows to $95,000. But the long-term implications are still being digested. Adding another layer to this economic onion, the Fed is also resuming its Treasury security purchases, starting with a hefty $40 billion in Treasury bills. This is a move to inject liquidity into the financial system and address concerns in the overnight funding markets. It's like the Fed is a firefighter spraying a hose of cash to prevent any potential fires from spreading. This influx of liquidity can also find its way into the crypto market, providing a potential tailwind for prices. But it's not all sunshine and rainbows. The labor market is showing signs of a low-hire, low-fire environment, with employers hesitant to either expand their workforce or lay off existing employees. Announced layoffs through November have topped 1.1 million, according to Challenger Gray and Christmas, and recent unofficial data suggests heavier job reductions may be on the horizon. The Fed's inflation projections show that prices are expected to remain above the 2% target until 2028, with the current inflation rate at 2.8%. This persistent inflation could limit the Fed's ability to cut rates aggressively, which would impact risk assets like crypto. And with the political landscape in a state of flux, with a new Fed chair to be nominated soon by the Trump administration, the future of monetary policy is as clear as mud. Kevin Hassett, the National Economic Council Director, is currently predicted to be the likely nominee with 72% odds according to prediction markets. Trump has indicated a preference for lower rates, which could influence future policy direction. All of these factors create a complex and challenging environment for traders. It's like trying to solve a Rubik's Cube in the dark. But don't worry, we're here to help you find the solution. Now, let's get down to the nitty-gritty, the technical analysis. This is where we look at the charts, the patterns, and the indicators to try and predict where the market is headed. We'll start with the short-term traders, the day traders, the scalpers, the ones who live and breathe by the 1-hour and 4-hour charts. For you, my fast-fingered friends, the key is to be nimble. The market is volatile, and the trend can change in the blink of an eye. On the 4-hour chart for Bitcoin, we're seeing a classic battle between the bulls and the bears. The price is currently consolidating in a range between $85,000 and $90,000. A breakout above $90,000 could signal a move towards the recent highs of around $95,000. A break below $85,000, on the other hand, could open the door to a retest of the $80,000 support level, which was recently tested and held. Your triggers for a long trade would be a confirmed breakout above the $90,000 resistance level, with a stop loss placed just below the breakout point, perhaps around $88,500. You'd want to see strong volume accompanying this breakout, ideally above the recent average volume of $98 billion. For a short trade, you'd be looking for a breakdown below the $85,000 support, with a stop loss just above, around $86,500. And always pay attention to volume. A breakout or breakdown on low volume is like a car trying to start with a dead battery. It's not going to go very far. You want to see a surge in volume to confirm the move. Additionally, watch the relative strength index on the 4-hour time frame. If it's approaching oversold levels below 30, that could indicate a potential bounce. Conversely, if it's in overbought territory above 70, we might see a pullback. The key support levels to monitor are $85,000, $82,000, and $80,000. On the resistance side, watch $90,000, $92,500, and $95,000. These are your battle lines for the next 24 to 48 hours. Now, for the mid-term traders, the swing traders, the ones who like to hold their positions for a few days or weeks, you're looking at the daily and weekly charts, and the picture is a bit different. On the daily chart, Bitcoin is still in an uptrend, but it's showing signs of exhaustion. The relative strength index is hovering around the neutral zone, having come down from overbought territory. This suggests that the recent rally might be losing momentum. However, the moving average convergence divergence is still showing a bullish signal, with the MACD line above the signal line, though the histogram is starting to flatten out. It's a mixed bag, a classic case of the market can't make up its mind. Your strategy here is to be patient. You're not looking to catch every little wiggle and jiggle in the price. You're looking for the bigger moves. A key level to watch is the 50-day moving average, which is currently around $82,000. A break below this level would be a bearish signal, suggesting a deeper correction is on the way. This could potentially lead to a test of the 200-day moving average, which sits around $75,000. On the upside, a sustained move above $95,000 with increasing volume would confirm the continuation of the uptrend and could target the psychological $100,000 level. Your triggers would be a daily close above or below these key levels, with a corresponding increase in volume. If we close below $82,000 on strong volume, that's your signal to either exit long positions or consider entering short positions with a target around $75,000. If we close above $95,000, that's your green light to add to long positions with a target of $100,000 to $105,000. Risk management is crucial here. Use proper position sizing and always have your stop losses in place. And finally, we come to the long-term traders, the hodlers, the ones who are in it for the long haul. You're looking at the weekly and monthly charts, and you're not too concerned with the day-to-day noise. You're focused on the big picture, the fundamental drivers of the market. On the weekly chart, Bitcoin is still in a clear uptrend. The price is well above the 200-week moving average, which is a key long-term support level, currently sitting around $45,000. As long as we stay above this level, the long-term trend remains bullish. The recent dip is just a blip on the radar, a healthy correction in a larger bull market. Historically, Bitcoin has experienced multiple 20 to 30% corrections during bull runs, and this appears to be another one of those instances. Your strategy is to accumulate on the dips. When the fear and greed index is flashing extreme fear, that's your signal to start buying. You're not trying to time the market perfectly. You're dollar cost averaging, buying a little bit at a time, and building your position for the long term. Consider setting up a systematic buying plan where you purchase a fixed dollar amount of Bitcoin and Ethereum at regular intervals, regardless of the price. Your focus is on the fundamentals. You're looking at the adoption of cryptocurrencies, the development of the technology, and the regulatory landscape. The recent approval of Bitcoin ETFs has brought institutional money into the market. Major corporations are adding Bitcoin to their balance sheets. Countries are exploring Bitcoin as legal tender. These are all long-term bullish catalysts that far outweigh the short-term volatility we're seeing today. You're not just investing in a ticker symbol. You're investing in a revolution, a fundamental shift in how we think about money, finance, and value transfer. And from that perspective, the future is still very bright. The network fundamentals remain strong, with hash rate at all-time highs and transaction volumes continuing to grow. The Lightning Network is expanding, making Bitcoin more viable for everyday transactions. So, for the long-term trader, the message is simple. Stay the course. Don't let the short-term volatility shake you out of your position. Remember why you invested in the first place? And if you have the conviction, use these dips as an opportunity to add to your holdings. As the old saying goes, the time to buy is when there's blood in the streets. And right now, the streets are looking a little red. But for those with a long-term vision, this is precisely when fortunes are built. Looking ahead, we have some key events to monitor. December 19th marks the monthly options expiry for both Bitcoin and Ethereum. There's significant open interest on these options, which could lead to increased volatility as contracts settle. Year-end positioning and portfolio rebalancing by institutional investors could also create price swings. Keep an eye on inflation data releases and any statements from Fed officials that could shift rate expectations. So, what have we learned today? We've learned that the crypto market is a complex and fascinating beast, influenced by a multitude of factors, from the technicals of the charts to the macroeconomics of the global stage. We've learned that there's no one-size-fits-all approach to trading. The right strategy for you depends on your time frame, your risk tolerance, and your own personal goals. For the short-term trader, it's all about being nimble and reactive, watching those 4-hour charts like a hawk, and being ready to pounce on breakouts or breakdowns with proper volume confirmation. For the mid-term trader, it's about being patient and strategic, waiting for daily closes above or below key moving averages before making your move. And for the long-term trader, it's about having conviction and a steady hand, accumulating during periods of extreme fear, and focusing on the fundamental revolution that cryptocurrency represents. But no matter what type of trader you are, the key is to stay informed, to do your own research, and to never invest more than you can afford to lose. Use proper risk management. Set your stop losses. Don't let emotions drive your decisions. The market doesn't care about your feelings or your bills. It's a cold, hard, and often brutal teacher. But if you're willing to learn, if you're willing to adapt, and if you're willing to put in the work, it can also be incredibly rewarding. And remember, the market is always right. It doesn't care about your opinions or your feelings. It's a cold, hard, and often brutal teacher. But if you're willing to learn, if you're willing to adapt, and if you're willing to put in the work, it can also be incredibly rewarding. That's all the time we have for today on Boni's Life. I hope you found this episode helpful and informative. If you did, please be sure to hit that like button, subscribe to the channel, and ring that notification bell so you don't miss our next episode. And as always, I'd love to hear your thoughts in the comments below. What are your predictions for the market? What are your trading strategies? Are you buying this dip or are you waiting for lower prices? Let's continue the conversation. Until next time, trade smart, stay safe, and may the crypto gods be ever in your favor. I'm Boni, and this is Boni's Life.